Grab yourself a pillow, make yourself comfortable, let your body sink into wherever you are right now, and let your breathing slow down just a little, because tonight we are going to travel somewhere very quiet, somewhere that does not look like much from the outside, a plain office building in Malvern, Pennsylvania, surrounded by modest landscaping and unremarkable roads. And yet from this place, something extraordinary happened, something that touched the lives of tens of millions of ordinary people, without fanfare, without a charismatic founder on magazine covers, without a single advertisement promising you the world. This is the story of Vanguard and of the man who built it, John Clifton Bogle, a man who believed, with quiet and unshakable conviction, that the financial industry had been getting it wrong for a very long time, and that there was a better way, a simpler way, a way that asked for almost nothing from you except patience and time. Tonight, we are going to walk through that story together, slowly, gently, letting the details settle over you like a warm blanket on a cool evening. There is no rush here. The story is long and rich and full of small moments worth lingering in, so let your eyes grow heavy if they want to. Let your thoughts drift when they need to, because the story will carry you all the way through. John Bogle was born on May 8, 1929, in Montclair, New Jersey, and the timing of his birth is worth pausing on for just a moment, because just a few months after he came into the world, the American stock market collapsed in one of the most dramatic crashes in financial history. The Great Depression swept across the country and changed everything it touched, including the Bogle family. His father, William Yates Bogle Jr., had been a reasonably comfortable man, but the Depression stripped that comfort away with a slow and grinding efficiency. The family moved frequently, finances were tight, and the weight of financial uncertainty settled into young John's earliest memories. Like a quiet fog that never quite lifted, it shaped him, not in a dramatic or resentful way, but in a slow and steady way, the way that difficult early years sometimes shape people into builders, into people who want to create something lasting and solid, something that cannot be so easily swept away. He was a bright student, and he earned a scholarship to Blair Academy, a preparatory school in New Jersey, and later won a scholarship to Princeton University, which in the late 1940s was a world of quiet prestige and careful intellectual tradition. It was at Princeton that Bogle found his subject, not by accident, but by a particular kind of serendipity that feels almost cinematic in retrospect. In his senior year, searching for a topic for his thesis, he came across an issue of Fortune magazine from December 1949, and inside that magazine was an article about a relatively new and largely overlooked corner of the financial world, mutual funds. Mutual funds at that time were a modest and somewhat obscure instrument. Most Americans had never heard of them, and those in the financial industry treated them as a minor footnote, not the central story. But Bogle was captivated. He threw himself into researching them with the intensity of someone who has found exactly the right question at exactly the right moment in his life. His thesis, titled "The Economic Role of the Investment Company," was meticulous and thoughtful, and it contained within it the seeds of everything he would spend the next 50 years building. He argued that mutual funds should be managed in the interest of shareholders, not in the interest of the managers, not in the interest of the salespeople or the distributors, but in the quiet and simple interest of the people whose money was actually being invested. This sounds obvious when you say it out loud, and yet it was, at the time, a genuinely radical idea, because the mutual fund industry of the 1940s and 1950s was run primarily for the benefit of the people running it. The thesis impressed his professors enough that Bogle graduated magna cum laude in 1951, and it also caught the attention of someone who would change the trajectory of his life entirely. Walter Morgan, the founder of Wellington Management Company in Philadelphia, one of the oldest and most respected investment firms in the country at that time. Morgan had somehow come across Bogle's thesis, and he was impressed enough to offer the young Princeton graduate a job. And so, in the summer of 1951, John Bogle walked into the offices of Wellington Management, a young man with a thesis full of careful ideas and a mind already quietly turning over the question that would define his career. How do you build a financial company that truly serves the people who trust it with their savings? Wellington, at that time, was a conservative and quietly distinguished firm. Walter Morgan was a careful man who believed in balanced investing, in not chasing excitement, in the slow and steady compounding of returns over time. It was a philosophy that suited Bogle perfectly, and he absorbed it the way a dry sponge absorbs water, completely and gratefully. He worked hard, he learned quickly, and Morgan, recognizing something exceptional in his young protege, began to give him more and more responsibility. By the early 1960s, Bogle had risen through the ranks with a steadiness that mirrored the investment philosophy of the firm itself. Slow, consistent, reliable. He was not flashy. He was not a showman. He dressed plainly and spoke plainly, and believed that the work itself was the point, not the performance of the work, not the appearance of sophistication, just the quiet, daily effort of doing things correctly. Morgan, aging and looking toward the future of the firm he had built, began to groom Bogle as his successor, and in 1965, at just 36 years old, Bogle was effectively running Wellington Management. It was a remarkable achievement for a man his age, and it would have been enough for most people. A prestigious firm, a secure position, a comfortable life in the Philadelphia suburbs. But Bogle was already thinking further, already turning over larger questions in his mind, already sensing that there was something more to be done, something important, something that the industry had not yet figured out. The late 1960s were an unusual time in American finance. A kind of euphoria had settled over Wall Street, a belief that brilliant fund managers with the right instincts and the right connections could consistently beat the market, could find the hidden gems, could time the rises and the falls, and deliver returns that made ordinary index-level performance look dull and unambitious. These managers were celebrated. They appeared on magazine covers. They were called gunslingers, and the money poured into their funds from investors who believed that paying higher fees for a star manager was simply the rational thing to do. Bogle watched all of this with a growing unease. He had read the academic research, he had studied the numbers carefully, and what the numbers showed, quietly and without drama, was that most actively managed funds did not beat the market over long periods of time. When you factored in the fees, the trading costs, the taxes generated by frequent buying and selling, the average actively managed fund delivered less to its investors than a simple unmanaged basket of stocks would have. This was not a popular observation. It was not what the industry wanted to hear, and it was certainly not what the gunslingers wanted to hear. But Bogle believed it deeply, and he began to wonder what it would look like to build something different, something that did not try to beat the market at all, but simply tried to match it at the lowest possible cost to the greatest possible benefit of the ordinary investor. The irony of what came next is almost too perfect, because just as Bogle was developing these ideas, just as he was becoming more convinced that the industry needed to change, his own position at Wellington began to unravel. In the late 1960s, feeling pressure to modernize and compete with the go-go funds of the era, Bogle engineered a merger between Wellington Management and a Boston investment firm called Thorndike, Doran, Payne, and Lewis. The Boston firm managed a growth fund called the iVest Fund, and its managers had the youthful energy and aggressive style that seemed to be winning in those heady years. The merger seemed sensible at the time, a way for the conservative Wellington to stay relevant in a market that was rewarding boldness. But the timing was unfortunate, almost poetically so, because shortly after the merger, the market turned. The go-go era ended with a sharp and painful correction, and the aggressive growth funds that had seemed so brilliant in the bull market looked very different in the bear market that followed. The Boston partners became disillusioned, the working relationship between the two camps frayed, and in January 1974, the Wellington Management Board voted to remove John Bogle as the head of the firm. It was a professional humiliation of the first order, the kind that breaks some people entirely. But what happened next is the part of the story worth really settling into, because Bogle did not crumble, and he did not simply accept the situation as it was. Instead, he found a narrow technical path through it, a legal and structural path that would eventually become the foundation of something entirely new. The Wellington funds, the actual mutual funds that held the money of ordinary investors, were technically separate entities from Wellington Management, the company that managed them. They had their own board of directors, their own legal structure, their own identity, and Bogle, stripped of his role at Wellington Management, turned his attention to those funds and began to argue that they deserved to be run independently, that they deserved to have their own management company, one that answered to the fund shareholders and no one else. It took months of careful negotiation, months of meetings and arguments and legal maneuvering, but in September 1974, the board of the Wellington Funds agreed, and a new company was born. It was named after a British naval warship. Most investment companies are owned by outside shareholders or private owners, people who have invested capital in the management company and expect a return on that investment. This means that when you pay fees to an ordinary mutual fund, some of that money flows to the owners of the management company as profit. That is simply how most businesses work, and there is nothing inherently wrong with it. But Bogle designed Vanguard differently. Vanguard was structured so that the mutual funds themselves owned the management company, which meant that the investors in the funds, the ordinary people saving for retirement or college or a quiet future, they were the owners. There were no outside shareholders expecting a profit. There was no private owner extracting value. The only people who mattered, structurally and legally, were the fund investors themselves. This meant that any profits generated by the management company did not flow out to external owners. They flowed back to the funds, which meant lower fees for investors, which meant more of their money stayed invested and compounding over time. It was an elegant structure, almost deceptively simple, and it set Vanguard on a path that no other major fund company has ever fully replicated. But in September 1974, all of that was just potential, just a structure on paper and a set of carefully held beliefs in the mind of a 55-year-old man who had just been fired and was starting over with a small staff and a second-hand photocopier in a modest office building in Valley Forge, Pennsylvania. The early days of Vanguard were humble in a way that is almost charming to think about now. The staff was small, the budget was tight, and Bogle operated under a strict limitation imposed by the Wellington Board, which had allowed Vanguard to exist, but did not want it to compete directly with Wellington Management. So Vanguard, at the beginning, was not permitted to manage money actively. It could only handle administrative functions for the funds. It sounds like a crippling restriction, and in some ways it was, but it also pushed Bogle toward the idea he had been quietly developing for years. If Vanguard could not manage money actively, what if it managed money passively? What if it created a fund that simply bought and held every stock in the market, tracking a broad index, requiring no star manager, no expensive research team, no frequent trading, just a quiet, steady, mechanical process of owning the market as a whole? The idea had been in the academic literature for years. A University of Chicago economist named Eugene Fama had published research in the 1960s suggesting that markets were largely efficient, meaning that prices already reflected all available information, and that it was therefore very difficult for any manager to consistently beat the market by picking individual stocks. Other researchers had reached similar conclusions, and a few people in the industry had begun to experiment with index funds for large institutional investors, but no one had yet offered an index fund to ordinary individual investors. No one had packaged the idea in a form that a school teacher or a factory worker or a nurse could simply invest in through a brokerage account. Bogle decided that Vanguard would be the first. On December 31st, 1975, he filed the paperwork for what would become the first index investment trust, the world's first index mutual fund available to individual investors. It was a simple fund, almost shockingly simple by the standards of the industry. It would buy the stocks of all 500 companies in the Standard & Poor's 500 index, in proportion to their size, and hold them forever, or as close to forever as a financial instrument can manage. No stock picking, No market timing, no star manager, just the market itself, quietly owned and quietly held. The financial industry's reaction was immediate and largely contemptuous. Fidelity's chairman called it Bogle's folly. Others called it the un-American fund, because it had abandoned the dream of beating the market, because it settled for average, because it did not try to win. The criticism stung, but Bogle had the numbers on his side, and he had a conviction that was not going to be moved by mockery. The fund launched in August 1976. It was supposed to raise $150 million in its initial offering. It raised $11 million. $11 million was not nothing, but it was not what Bogle had hoped for, and it was not what the underwriters had expected. There was a quiet embarrassment attached to that moment, a sense that perhaps the critics had been right, that ordinary investors did not want average, that they wanted the dream of something better. But Bogle did not close the fund. He kept it running. He kept the costs low. He kept the structure intact. And he waited, because he understood something that the critics did not. He understood that the power of his idea was not visible in any single year. It was only visible over decades, and decades require patience. The 1970s were a difficult time for American markets in general. Inflation was high, economic uncertainty was pervasive, and investors were cautious in ways that made bold financial innovation a hard sell. But the fund survived, and it grew, slowly at first. A few million here, a few million there, each year slightly larger than the last. In those early years, Bogle spent enormous amounts of time thinking about costs, about the quiet and invisible drag that fees imposed on long-term investment returns. He had developed what he called the cost matters hypothesis, which was simpler and more direct than the efficient market hypothesis that academics debated. The cost matters hypothesis said simply this: in any given market, all investors together must earn the market return before costs, and after costs, they must earn less than the market return. Therefore, low-cost investors must, as a group, outperform high-cost investors. It was not a hypothesis that required much mathematical sophistication. It was almost embarrassingly straightforward, but it had profound implications, because it meant that a low-cost index fund did not need to be clever. It did not need to hire brilliant analysts or pay for expensive research. It just needed to be cheap, and over long periods of time, cheap would win. Bogle pushed Vanguard's costs lower and lower, with an almost obsessive dedication. Every basis point mattered to him, a basis point being 0.01%, which sounds trivially small, but compounded over 30 years. The difference between a fund charging 1.5% annually and a fund charging 0.15% annually was the difference between retiring with a comfortable sum and retiring with a dramatically larger one. He liked to tell a simple story to illustrate this. Imagine two investors, each starting with $10,000, each earning the same gross market return of 7% per year, but one paying 2% in annual fees and one paying 0.2% in annual fees. After 40 years, the first investor has about $72,000. The second has about $209,000. Same market, same starting point, same 40 years, but a difference of nearly $140,000, all lost to fees, all transferred, quietly and invisibly, from the investor to the fund company. This was the number that Bogle could not stop thinking about. This was the silent theft that he believed the industry was perpetrating on the ordinary American saver, not through fraud, not through malice, but simply through the quiet accumulation of fees that most investors never stopped to calculate. Throughout the late 1970s and into the 1980s, Vanguard continued to grow, slowly building a reputation by the mid-1980s, Vanguard had grown to manage several $billion, which sounds enormous until you compare it to the industry giants of the era. Fidelity and Merrill Lynch and the major brokerage houses managed hundreds of billions, and Vanguard was still a relatively modest presence, a quiet and slightly eccentric outlier that the mainstream industry regarded with a mixture of bemusement and mild irritation. But the people who worked at Vanguard felt something different. They felt that they were part of something meaningful, something that genuinely served investors rather than extracting from them, and Bogle cultivated that feeling deliberately. He called the fund investors, not clients, but owners, because that is what they were. He wrote to them in plain language, not the deliberately obscure jargon that the financial industry often used to discourage close reading, but in simple, direct sentences that explained exactly what Vanguard was doing with their money and why. He called this his battle for the soul of capitalism, a phrase that might sound dramatic for a man managing a collection of mutual funds in suburban Pennsylvania, but which reflected the genuine depth of his conviction. He believed that the financial system existed to serve the real economy, to direct capital toward productive uses, to help ordinary people build wealth over time, and he believed that a financial industry that existed primarily to enrich itself at the expense of its clients was a betrayal of that purpose, not just economically, but morally. Bogle was a deeply moral man in a way that was not fashionable. He was not interested in the performative philanthropy of writing large checks to prestigious institutions. He was interested in the daily ethics of how a business was run, in whether the people running the business were genuinely serving the people who trusted them. He attended the Episcopal Church with quiet regularity. He believed in stewardship, in the idea that managing other people's money was a sacred trust that demanded the highest standards of integrity. These were not ideas he kept private. He said them out loud. He wrote them in his annual letters to shareholders. He repeated them in speeches and books with a consistency that bordered on preaching, which occasionally annoyed people, but which also created something very valuable, a company culture of genuine purpose. In the late 1980s, Vanguard introduced several new funds, expanding beyond the original index fund to offer bond index funds, international index funds, and a range of low-cost, actively managed funds as well, always with the same structural commitment to low costs and investor ownership. The company was growing, but it was growing in a particular way, organically, through word of mouth, and through the slow accumulation of trust. Vanguard did not advertise heavily in those years, partly because Bogle was philosophically suspicious of advertising, which he saw as a form of salesmanship that benefited the seller more than the buyer, and partly because he believed that good performance and low costs should speak for themselves. This was an unusual stance in an industry that spent heavily on marketing, and it was occasionally criticized as naive, but it turned out to be one of Vanguard's great strengths, because the investors who found their way to Vanguard tended to be people who had done their homework, people who were committed to the long term, people who were unlikely to panic and sell during market downturns, which meant that Vanguard's asset base was more stable than that of many competitors. The 1990s were a decade of transformation for Vanguard, and for American investing more broadly. The rise of the personal computer and the early internet made financial information more accessible than it had ever been before. Individual investors could now read research reports, compare fund performance, calculate the impact of fees on their returns, and increasingly, when they ran those calculations, the conclusion pointed in one direction: Vanguard. The decade also brought a dramatic expansion of the 401k system, which had been created by a small provision in the Revenue Act of 1978 and had been growing quietly ever since. By the early 1990s, it was becoming the primary retirement savings vehicle for millions of American workers, and the 401k created an enormous new pool of long-term savings that needed a home. Vanguard was perfectly positioned to receive it, because 401k investors were not day traders or speculators. They were ordinary workers, putting away a portion of each paycheck for a retirement that might be 30 years away. And for investors with that time horizon, the case for low-cost index funds was overwhelming. Assets flowed into Vanguard through the decade with increasing speed: 10 billion, 50 billion, 100 billion. The numbers that had seemed so distant in 1976, when the first index fund raised $11 million, were now being eclipsed by a single good quarter. The bull market of the 1990s helped, of course. A rising tide lifts all boats, and Vanguard's boats were rising with the rest. But there was a difference, because when the market rose, Vanguard investors kept more of that rise, and when the market eventually fell, they would lose less of their savings to fees along the way. The late 1990s brought a particular challenge to Bogle's worldview, the dot-com boom, a period of extraordinary market euphoria centered on internet companies, many of which had no earnings, no profits, no clear path to profitability, but which carried stock prices that implied they would someday rule the world. The speculative frenzy of those years was exactly the kind of thing Bogle found most troubling about financial markets, the abandonment of fundamental value in favor of narrative and momentum. He said so, publicly and repeatedly, which made him an unfashionable voice in those years, a man who kept talking about costs and long-term thinking, while the market roared upward and people around him were getting rich, or at least appearing to get rich, on technology stocks they barely understood. But Bogle also faced a more personal challenge in those years. In 1996, after decades of living with a congenital heart disease, the early 2000s brought the dot-com crash, and with it a painful but clarifying moment for American investors. The companies that had seemed so brilliant in 1999 collapsed with a swiftness that left many individual investors deeply hurt. Actively managed funds that had poured money into technology stocks suffered dramatic losses, and the case for low-cost, broadly diversified investing looked stronger than it had in years. Vanguard continued to grow, now under the leadership of Jack Brennan, who had joined the company in 1982 and had absorbed the culture and philosophy deeply enough to carry it forward with genuine conviction. Brennan was a different personality from Bogle, quieter in some ways, more focused on operational excellence and organizational development, less inclined to public advocacy and moral argument, but he shared the core belief that Vanguard existed to serve its investors, and under his leadership, the company continued to push costs down and assets up. By the early 2000s, Vanguard was managing hundreds of billions of dollars, and the index fund concept that had been dismissed as Bogle's folly in 1976 was now a mainstream fixture of the financial landscape. Every major fund company had launched index fund products of their own, though many of them charged significantly higher fees than Vanguard, and none of them had the ownership structure that gave Vanguard its fundamental cost advantage. Meanwhile, Bogle was writing. He produced a series of books in his retirement years that became essential reading for anyone who wanted to understand what had gone wrong with American finance and how to protect themselves from it. Quote, Common Sense on Mutual Funds in 1999, The Battle for the Soul of Capitalism in 2005, The Little Book of Common Sense Investing in 2007, which became perhaps his most widely read work, a slim and elegantly argued case for index investing that was accessible enough for a first-time investor and rigorous enough for a financial professional. The little book had a clarity and conviction that reflected decades of thinking about a single idea, and it reached hundreds of thousands of readers who might never have engaged with the academic literature, but who came away from it with a clear and actionable understanding of how to invest their savings. Bogle was a gifted writer. He had the rare ability to make financial concepts feel not just understandable, but morally significant. He made you feel that how you invested was not merely a technical question, but an ethical one, that choosing a low-cost fund over a high-cost one was not just financially sensible, but a small act of self-respect, a refusal to be taken advantage of by a system that was designed to extract from you rather than serve you. He wrote with a warmth and directness that his readers responded to deeply. He received enormous quantities of mail from ordinary investors who had read his books and felt that someone was finally telling them the truth about how the financial industry worked. And he answered that mail personally, carefully, treating each letter as the meaningful communication that it was, from someone who had trusted him with their financial future. The 2008 financial crisis was another clarifying moment, perhaps the most dramatic in Bogle's lifetime. The collapse of the housing market and the financial instruments built upon it sent shockwaves through the global economy. Major financial institutions failed or required government bailouts. Stock markets around the world fell by 50% or more. Retirement accounts shrank dramatically overnight, and millions of ordinary Americans faced a financial reckoning that was not of their making. Bogle watched it all with a mixture of grief and vindication. Grief because he understood what it meant for the ordinary people who had saved carefully and seen their savings halved, and vindication because the crisis was, in many ways, a perfect illustration of everything he had been warning about for decades: the excessive complexity, the misaligned incentives, the culture of short-term speculation masquerading as investment, the industry that had grown rich by selling ordinary people products that served the industry more than the investors. All of it had contributed to a disaster that was now being paid for by the very people who could least afford it. He wrote about it, he spoke about it, he testified before Congress about it, always in that same plain, direct voice that had been his signature for 50 years. Always coming back to the same simple point: when the financial system loses sight of its purpose, when it begins to serve itself rather than the economy and the investors it is supposed to serve, everyone eventually pays the price. The years after 2008 brought a remarkable recovery in American markets, a long bull run that lasted over a decade and lifted stock prices to extraordinary heights. And during this period, the flow of money into index funds became a flood. Investors who had seen their actively managed funds dramatically underperform in the downturn and then struggle to keep up in the recovery began to look seriously at the alternative that Bogle had been offering for 30 years. The numbers by now were conclusive. Study after study showed that over periods of 10 years or more, the overwhelming majority of actively managed funds underperformed their benchmark indices after costs, and the minority that did outperform in one period rarely sustained that outperformance in the next. The case for index investing was not just strong, it was as close to empirically settled as anything in finance could be, and the financial industry, slowly and somewhat reluctantly, acknowledged it, not by changing its fundamental business model, not by lowering its fees to match Vanguard's, but by launching its own index fund products and marketing them to investors who had come to see low-cost passive investing as the standard against which everything else should be measured. This was, in its quiet way, it is worth pausing here, in the quiet middle of this story, to think about what Vanguard actually felt like from the inside, not from the perspective of the balance sheet or the asset totals, but from the perspective of the people who worked there and the investors who trusted it, because one of the unusual things about Vanguard was the culture it created, a culture that was, by the standards of the financial industry, almost aggressively humble. There were no lavish corporate headquarters, no art collections hanging in the lobby, no fleet of corporate jets or boxes at sporting events. Bogle had made his feelings about corporate excess very clear, and those feelings had shaped the physical and cultural reality of the institution. The buildings in Malvern, Vanguard had eventually moved from Valley Forge to the neighboring community of Malvern, were functional and pleasant, but not impressive. They looked more like the campus of a mid-sized insurance company than the headquarters of one of the largest financial institutions in the world. The employees were called crew members rather than staff or employees, a nod to Bogle's love of naval history and to the metaphor of the fleet of ships that he liked to use when describing the company. "We are all in this together," he would say, the crew and the investors, sailing in the same direction. The culture attracted a particular kind of person, people who were motivated by the mission more than the paycheck, because Vanguard, in keeping with its philosophy of cost minimization, did not pay its executives at the levels that comparable positions at other major financial firms commanded. There were no enormous bonuses tied to asset growth, no stock options that could make a vice president wealthy overnight, just salaries that were competitive but not extraordinary, and a genuine sense of purpose that compensated for the financial restraint. This was unusual enough in the financial industry to be genuinely remarkable, because the financial industry as a whole was, in the decades following deregulation, one of the highest-paying sectors of the American economy. The lure of enormous bonuses had drawn many of the brightest graduates of the best universities into finance, not because they particularly cared about capital allocation, but because the money was simply extraordinary. Vanguard was different. and the difference showed in the longevity of its employees, many of whom stayed for decades, building careers in an institution that they felt genuinely proud to be part of. This stability had practical benefits. Experienced employees who understood the company's systems and values deeply, made fewer mistakes, served investors more consistently, and maintained the institutional knowledge that was one of Vanguard's quiet competitive advantages. There is something worth reflecting on here about what it means to build an institution that genuinely serves the people it exists to serve. Bogle believed that the purpose of a financial company was not to maximize its own profits, but to serve its investors, and he had designed Vanguard in such a way that those two things were perfectly aligned. When Vanguard served its investors well, when it kept costs low and maintained the integrity of its funds, it grew, and when it grew, it could keep costs even lower, creating a virtuous cycle that no competitor with a traditional profit-seeking structure could easily replicate. This was the genius of the structure, not just that it was ethically admirable, but that it was economically self-reinforcing. The lower costs attracted more investors. More investors meant larger scale. Larger scale meant even lower costs, and lower costs attracted even more investors. A compounding cycle of growth that mirrored, in its own institutional way, the compounding of returns that Bogle preached to individual investors. By the 2010s, Vanguard's scale was so large that it was having effects on the financial markets that went far beyond the simple provision of low-cost investment products. When you own shares in a Vanguard index fund, you are indirectly an owner of virtually every publicly traded company in America, and Vanguard, as the largest shareholder in many of those companies, had accumulated an enormous amount of shareholder power that it was increasingly being called upon to exercise. The question of how Vanguard should use that power, whether it should be an active and engaged shareholder, pressing companies on governance and environmental and social issues, or whether it should remain a passive vehicle that simply reflected the market without trying to shape it, became one of the central debates about the company in its later years. Bogle himself had complex views on this. He believed that Vanguard's primary obligation was to its investors, and he was wary of the company using its shareholder power to advance political or social agendas that its investors had not explicitly endorsed. But he also believed that good corporate governance, honest accounting, reasonable executive compensation, these were not political issues, but fundamental requirements of a well-functioning market, and that Vanguard had an obligation to press for them. The debate continues today and is unlikely to be fully resolved because it touches on genuinely difficult questions about the role of large institutional investors in a democratic economy, about what it means for a handful of enormous index fund companies to collectively own significant stakes in virtually every major corporation, about whether passive investment is truly passive when the vehicle for it is large enough to shape the behavior of the companies it owns. These are not comfortable questions, and they do not have simple answers, but they are the questions that Vanguard's success has made unavoidable. In the years following Bogle's retirement, Vanguard continued to evolve. New leadership brought new emphases, new products were added to the lineup. The company expanded internationally, opening offices in Australia and Europe and Asia, offering low-cost index funds to investors around the world who had previously had access only to the expensive, actively managed products that their local financial industries provided. The expansion was careful and deliberate, not the aggressive global rollout of a company trying to maximize market share at any cost, but the considered growth of an institution that was aware of its own values and wanted to preserve them. As there is a number that Bogle liked to use in his later years, a number that captures something essential about what Vanguard accomplished for ordinary investors. He estimated that over the lifetime of the index fund, from 1976 through the years of his active writing and speaking, the savings in fees delivered to Vanguard investors, compared to the industry average, amounted to hundreds of billions of dollars. Some estimates put the total at over $1 trillion in aggregate savings, returned to ordinary investors rather than flowing to fund companies as profit. $1 trillion, quietly and invisibly transferred back to the people who had earned it and saved it and trusted the financial system with it, not through legislation, not through regulation, not through any dramatic political intervention, but through the simple act of building a company with a different structure and a different set of priorities, and then holding firm to those priorities for decades in the face of mockery and skepticism and the constant temptation to do what everyone else was doing. It is one of the most remarkable acts of quiet financial philanthropy in American history, and it was accomplished not by a charity or a foundation, but by a for-profit company, or rather by a company whose unusual structure made profit and purpose one and the same thing. Bogle himself was never wealthy in the way that the founders of comparable financial institutions became wealthy. He could have been. The structure of Vanguard was his idea, but the structure was specifically designed to prevent that kind of personal enrichment. The company was owned by its investors, not by him. And so, the enormous growth of assets under management translated into enormous benefits for investors, but not into personal wealth for its founder. He lived comfortably, but modestly, by the standards of the financial industry. He did not own yachts, or private planes, or multiple homes. He worked in an office, and drove to work, and came home in the evening to his family. He had 6 children, with his first wife, Eve, whom he married in 1956, and who died in 2020. And his family life had the same quiet solidity that characterized his professional life. There were difficulties, there always are, in a long marriage and a large family, but there was also a deep rootedness, a sense of belonging to a place and a community that gave his extraordinary professional life a human scale. He was known in the community of Malvern and the surrounding Philadelphia suburbs, not as a financial titan, but simply as a neighbor, someone who attended church and walked in the neighborhood and was recognizable to people at the local grocery store. He seemed to prefer it that way. He was offered honorary degrees from dozens of universities. He gave speeches at business schools and investment conferences around the world, and he received genuinely warm receptions at all of them. But he always came home to the same modest house and the same community. He did not think of himself as famous. He thought of himself as someone who had found the right idea at the right time and had had the stubbornness to hold on to it long enough for the world to catch up. There is a particular kind of person in American business history who achieves greatness not through charisma or dramatic innovation, but through the patient defense of a simple truth, through the refusal to be distracted or seduced or discouraged, through the daily discipline of doing the same right thing over and over for decades until the evidence becomes undeniable. Bogle was that kind of person, and Vanguard was the monument to that kind of greatness. Not a gleaming tower in Manhattan, not a name on a stadium, but a quiet office complex in suburban Pennsylvania that processes billions of transactions every day on behalf of 20 million ordinary people who are simply trying to take care of themselves and their families. After Bogle's departure from Vanguard in 1999, the company continued under a succession of leaders who were all, in their different ways, inheritors of the culture he had created. Jack Brennan led until 2008, followed by Bill McNabb, and then Tim Buckley, each of them maintaining the fundamental commitment to low costs and investor ownership while adapting the company to the changing landscape of technology and global markets. Under Tim Buckley's leadership, Vanguard took steps that Bogle himself had not always supported, including the aggressive expansion of its ETF lineup and its international operations, and including a growing engagement with the question of how to use Vanguard's enormous shareholder power responsibly. These decisions generated internal debates and occasional public disagreements because Vanguard's size had made it impossible to remain simply a passive vehicle at the scale of $5 trillion, of $6 trillion, of $7 trillion. The question of what you do with your ownership stakes in virtually every publicly traded company is not one that can be avoided. It is a question that speaks to the limits of the index fund revolution, because while the revolution has been enormously beneficial to individual investors, while it has transferred hundreds of billions in savings back to ordinary people, it has also created a new concentration of shareholder power in the hands of a very small number of very large institutions. Vanguard, BlackRock, and State Street together own significant stakes in virtually every large public company in America, and the implications of that concentration for competition, for corporate governance, for the health of the democratic economy are still being worked out. Bogle was aware of this, and he was not entirely comfortable with it. In his later writings, he expressed concern about the growing concentration of the financial industry, about the possibility that index funds, if they grew large enough, might distort the very markets they were designed to reflect. He did not have simple answers to these concerns, but he took them seriously, and the fact that he took them seriously, that he was willing to acknowledge complications and tensions in the very idea he had championed for his entire career, speaks to the quality of his mind and the honesty of his character. He was not a true believer in the sense of someone who cannot see the limitations of their own beliefs. He was a careful thinker who had arrived at his beliefs through evidence and argument, and was willing to follow the evidence wherever it led, even when it led to uncomfortable places. In his final years, after the 2008 crisis and into the long bull market of the 2010s, Bogle returned repeatedly to a concern that had always been present in his writing, the concern that American capitalism was drifting from its roots, from the patient creation of real value through productive business activity, toward he worried about the growth of high-frequency trading, about the explosion of complex derivatives, about the way that the financial sector had grown as a share of the economy, consuming an ever larger slice of national income without, in his view, contributing proportionate value to the people and businesses it was supposed to serve. These concerns put him in an interesting and slightly awkward position as the father of the index fund, the man who had done more than anyone to democratize low-cost investing and make markets accessible to ordinary people. He was also one of the most prominent critics of the direction that financial markets had taken in the decades since he had made that contribution. He had not set out to make markets more speculative or more dominated by short-term thinking. He had set out to provide ordinary people with a simple, low-cost way to participate in the long-term growth of the economy, and he was genuinely troubled by the ways in which the financial culture around that simple idea had evolved in directions he had not intended and did not endorse. The rise of ETF trading was one example. Bogle had supported the index fund ETF in principle, but he was concerned about the way that the ease of trading ETFs had encouraged a short-term speculative mentality among some investors, people who used ETFs not as long-term savings vehicles, but as instruments for active trading, for moving quickly in and out of market sectors in pursuit of short-term gains. This was the opposite of what he had intended, the opposite of the patient, long-term, low-cost approach that the index fund was designed to embody, and he said so, clearly and repeatedly. Even as ETF assets grew and Vanguard's own ETF lineup expanded, he understood the tension. He accepted it as one of the complications that comes with scale and success, but he never stopped arguing for the simple, original idea: buy the market, keep costs low, stay the course. It is in some ways the most enduring and useful piece of financial advice that has ever been given to ordinary investors, and it came from a man who had spent 50 years resisting the temptation to make it more complicated than it needed to be. The legacy of John Bogle is one of those unusual things in business history that is both measurable and immeasurable. The measurable part is the hundreds of billions in fee savings, the 20 million investors served, the $5 trillion in assets managed at a fraction of the cost that the industry would otherwise have charged. The immeasurable part is harder to quantify, but perhaps more significant. It is the change in expectations, the shift in what ordinary investors believe they are entitled to from the financial system that manages their savings. Before Vanguard, most individual investors simply accepted that investing was expensive, that paying 2 or 3% in annual fees was the cost of access to professional management, that the financial industry was doing them a service by accepting their money and attempting to grow it. After Vanguard, after decades of Bogle's patient advocacy, after the evidence had accumulated into something undeniable, the standard changed. Investors began to ask hard questions about fees, began to compare the costs of different options, began to understand that every dollar paid in fees was a dollar not compounding in their account, and began to demand better. This shift in investor expectations drove every major fund company to offer lower-cost products, to compete more honestly on fees, to acknowledge that the era of charging high prices for services that did not justify them was coming to an end. The democratization of this knowledge is perhaps Bogle's most important contribution, more important even than Vanguard itself, because it changed not just the company, but the culture of investing. It changed what ordinary people believed was possible and what they believed they deserved. The story of Vanguard is ultimately a story about patience and about the extraordinary things that can happen when you find the right idea and hold on to it long enough. Bogle spent 25 years being largely ignored or dismissed by the mainstream financial industry. He spent another decade being grudgingly acknowledged and another decade being openly celebrated, by which point he was in his 80s with a borrowed heart and a pen that never seemed to stop moving. He once said that the two most powerful forces in the universe were compound interest and the irresistible tendency of things to regress to the mean. He meant it as a statement about investing, but it applies just as well to his own story, the patient accumulation of small advantages over time, the refusal to be seduced by the apparent brilliance of any particular short-term result, the trust that if you do the right thing consistently for long enough, the mean will find you, and the compound interest will do the rest. There is something deeply restful about that idea, something that invites you to let go of the anxiety of constant decision-making and simply trust a process that you have chosen carefully, that you understand clearly, and that you are willing to stick with through the inevitable fluctuations and doubts and moments of apparent failure that any long journey contains. Bogle understood that most of what looks like investing skill is actually just noise, the random variation of a complex system that is impossible to predict reliably, and that the appropriate response to that understanding is not paralysis or despair, but a kind of liberated simplicity. If you cannot predict the market, do not try. Simply own the market at the lowest possible cost and let the decades do their work. It is an idea that requires a particular kind of faith, not religious faith, but the quieter faith. Let us slow down now and let the story breathe a little, because we have moved through a lot of ground together. From that modest New Jersey childhood in the shadow of the Great Depression, through the Princeton Library and the Fortune magazine article that set everything in motion, through the careful years at Wellington, the merger that went wrong, the firing that became a founding, the $11 million launch that became a $5 trillion institution, and through all of it, the constant presence of one quietly extraordinary man who believed a simple thing and would not stop believing it, no matter what the world said. It is worth lingering on that simplicity for a moment, because it is genuinely rare. The financial world is filled with complex ideas, with intricate strategies and sophisticated instruments, and brilliant people building ever more elaborate systems for extracting value from markets. And most of those systems work for a while, and then they do not, because complexity has a way of failing precisely when you need it most, when markets are stressed and liquidity is thin, and the assumptions underlying the model no longer hold. Bogle's idea had no such weakness, because it made no assumptions about the future. It did not depend on any particular sector performing well, or any particular manager making good decisions. It simply said, the economy will grow over time, and if you own a piece of all of it, you will participate in that growth, minus costs, and the lower your costs, the more of that growth you will keep. It is almost too simple, which is perhaps why it took so long for the industry to accept it. The financial industry, like most human institutions, has a bias toward complexity, because complexity creates the appearance of expertise, and expertise justifies fees, and fees are how the people running the institution get paid. Bogle's simple idea was threatening, not just economically, but psychologically, because it implied that most of what the industry presented as expertise was not worth very much, that the elaborate process of research and analysis and stock selection and portfolio construction was, in the aggregate, a zero-sum game that generated costs without generating net value. Not everyone agreed with this conclusion, and the debate between active and passive investing continues to this day. There are intelligent people who believe that skilled active managers can consistently add value after costs, and there are specific markets and asset classes where the evidence for active management is stronger than in the large cap U.S. equity market. That was Bogle's primary focus, but even the strongest advocates for active management would acknowledge that Bogle's basic insight that costs matter enormously over long periods, that investors should think carefully about what they are paying and why, that the financial industry's incentives are not always aligned with the interests of investors, is correct and valuable, and something that far too few investors understood before he spent 50 years saying it. The physical place where all of this happened, Malvern, Pennsylvania, is worth a moment of attention. It is a quiet suburban community in Chester County, about 25 miles west of Philadelphia, the kind of place that does not appear on most maps of financial significance. Not New York, not Boston, not Chicago or San Francisco, just a modest Pennsylvania town with tree-lined streets and local restaurants, and the kind of peaceful ordinariness that Bogle seemed to find genuinely comfortable. Vanguard sits there still, a collection of low-rise buildings spread across a campus that is well-maintained but deliberately understated, the crew members parking in ordinary parking lots and walking to ordinary offices and processing transactions that collectively represent one of the largest pools of retirement savings in the world. There is something right about that setting, something that matches the philosophy it houses, because the whole point of what Vanguard does is to be invisible, to be so reliable and so frictionless that investors barely notice it, to be the opposite of the exciting, glamorous, dramatic financial product that promises spectacular results and delivers average ones after collecting spectacular fees. Vanguard aspires to be boring, and boring is exactly what a 25-year-old saving for retirement should want from the institution managing her savings, because boring means reliable, and reliable means that the money will be there when she needs it, compounded patiently over the decades between now and then. In the years since Bogle's death, the movement he started has continued to accelerate. Assets in passive index funds now exceed assets in active funds in the United States. For the first time in history, a milestone that would have seemed almost impossible when Bogle stood in that Valley Forge office in 1974 with a small staff and a second-hand photocopier and a conviction that he was right. The total shift of assets from active to passive investing represents one of the largest redistributions of wealth in modern financial history, not from the poor to the rich or from the rich to the poor, but from the financial industry to the investors. It serves hundreds of billions of dollars that used to flow as fees and profits to fund companies now remain in the accounts of ordinary investors, quietly compounding year after year. The people who have benefited most from this shift are not the wealthy, who can afford good financial advice and have access to institutional quality investment products, regardless of what happens in the retail fund market. The people who have benefited most are the middle class, the teachers and nurses and factory workers and small business owners who have 401k accounts and IRAs and who are trying to build enough wealth over a working lifetime to retire with dignity. It is for them that Bogle built what he built, and it is for them that the quiet revolution he started continues to matter. As you let yourself drift towards sleep tonight, let the numbers soften and recede. Let the structure of the story settle into something simpler. A man who found the right idea and held on to it, a company that was built to serve the people